Good day, grade 12s. My name is Carden Madzokere, and I'm the author and publisher of the distinction-bound student textbooks. So to prepare for the exams that are upcoming, I strongly believe it's ideal that we start with sort of a summary of each topic. So I have this workbook that I recently published, and let's go through some of the questions. So I'll go through it blank, then I'll just run through the answers in case you really want to have them. And but I think on the diagram I'm gonna show it and then I'll remove. Then when I'm done, I'll just show you the answers from start to the finish. Okay, but here I'm using the blank one so that it provokes your thinking, so that you think hard as to what could be the answer. So to get started, what is a model that shows how participants in an economy interact? Right, we start by analyzing this word model. A model is a representation of the real thing. So there's a model that we use to show how participants in an economy interact. So let's have a look at, we will be having a look at these participants and how they, relate with one another. So if you're answering here, you would have to write circular flow, okay? Because a circular flow is a model that shows how participants in an economy interact. Now, who are the participants in an open economy? Here I did not specify though, but what gives you the clue is the four. Okay, we have what we call a two-sector model that will be households and businesses. Now we have this one, a three-sector model, otherwise known as a closed economy, that will have households, businesses, and the government. Then this is a four-sector model that then includes the foreign sector, and so we might as well call it an open economy. Okay. Then we come here where they ask you to draw a circular flow diagram. So I'll bring in the answers. Okay. So here's a diagram that shows how participants interact. I'll just run through it quick. I won't spend time. I have a video on this, so that's why I won't spend much time here. Right, so here are our participants once again. So we have households, government, firms, and the foreign sector. These are the two markets, product and factor market. And I can talk about the financial sector as well, but it has a different color to show that it's not one of the main participants. It's more like an intermediary. So I'll just stick to the main participants. Okay, so first and foremost, the households own four factors of production. We'll talk about them just now. That is land, labor, capital, and entrepreneurship. They then sell these four factors of production on the factor market. Now they are selling these factors of production to government and firms. So we see here, this solid line represents the flow of factors of production. If you check here, it continues then. So firms are receiving factors of production from households, since households are the owners. In return, firms will pay for the factors of production. So to them, it's expenditure. So firms pay for factors of production to households. So that becomes income for households. Now, all this is happening on the factor market, so we might as well define it. So it is a market where factors of production are traded. Then the first thing we do when we get our income is that we pay tax. Now we pay tax because we need public goods and services from the government. So the state will use some factors of production to make provision of public goods and services. And so to fund those public goods and services, we have a taxing system, because these public goods and services are non-excludable and they are also non-rivalry. So firms would not want to make provision of these because firms would want to make a profit. So they cannot make profit from something that's non-excludable. For them to be able to make money, they have to be able to sell a product that is excludable so that they can be able to charge money from the sale of the product. Okay. So they also pay tax to the government, and for the same reason that we pay tax, firms also receive public goods and services from the government. Now, what we have left is what we call disposable income. Well, that's where we can put the financial sector into account. Now, you see here, a certain household will save money into financial institutions. We say they are in surplus. So they save whatever it is that they have in surplus. Now, some households would have deficits. So they drop a budget and they have less than they need. So they will probably have to borrow money from financial institutions. So we see a flow of money from financial institutions to households. Then we use that money to buy goods and services on the product market, but we're buying these from firms. Okay, so the market at which we are participating in this case will be the product market. So we might as well define it. So it is a market where goods and services are traded. Now, through the same market, goods are exported. Where do we have? Yes, goods are exported. In return, we receive money for the exported goods, and also goods are imported, and then money goes out of the country to the foreign sector. Now, if you check, all the lines that are solid in my whole circular flow diagram or model, it represents real flow, and all the dotted lines are representing money flow. And if you check properly, you'll see in all instances, real and money flow in the opposite direction. Okay, now I'll make my diagram disappear. Then, so you have to be able to draw what you saw here. Right, then here, what you have to do here is to discuss the relationship between the participants. So you pick any two participants that you want to talk about. So that would be maybe households and businesses. Then you tell us how they relate. So you can say something like households sell their factors of production to businesses. Okay, that will give you 2 marks. And then, so here you get a mark for saying households and businesses. So 1, 2. Then your description here will give you 2 marks. Then here you can say households and government. Then you say something like households pay tax to the government, something like that. You pick maybe government and firms. You say government provides public goods and services to firms, anything like that. So this is easy. Then moving on, are the primary participants. Okay, so your answer is A, the households, businesses, government, and the foreign sector, because we say participants. Now, I find some learners writing weird things like factor market, product market. They forget that those do not appear when it comes to participants. Even here, we don't have them. We have households, government, firms, and the foreign sector. So the question is asking for participants. So the answer is one of them. But let's listen carefully. And consumers of goods and services. So who is the main participant? If you look at those 4, you'll realize that it's households. Right. The next one. Who uses factors of production to manufacture what? Goods. Now, the key here is the part that says goods and services. Why? Because look here, we are not talking, who is producing goods and services here? Look, firms receive money. What is that money for? Firms supply goods and services. Do you see that government supplies something different? Public goods and services. So the question here is asking about firms or businesses. The next question, who uses factors of production to provide public goods and services? Again, we have answered this one. Households receive public goods and services. They are coming from which participant? They are coming from the government, as you can see. Okay. Then what are the 4 factors of production? That would be land, labor, capital, entrepreneurship. And please don't write entrepreneur. Because that an entrepreneur is a person, but a factor that the person provides is entrepreneurship. Okay, then number 9, profit is remuneration for what? So the answer is one of the 4. So we said land, labor, capital, entrepreneurship. So which of the 4 factors would give you profit as a remuneration? Obviously, that will be entrepreneurship. Then interest will be remuneration for what? Interest will be remuneration for capital. The next one is economic rent. Economic rent will be remuneration for land. Then lastly, when you get a wage or a salary, the factor that you will have provided is labor. Okay, now let's look at some economic symbols. Y, that's income. J, injection. C, consumption, spending by households. If you write consumption, it's wrong, because consumption is like using, right now I'm consuming my computer, and me consuming it, that's not C. This C here will be, let me show you. Right, you see, when households pay for goods and services, when we spend money, this is the C we are referring to. So when we pay money, we are buying. So I'm buying the computer, right? Then I get the computer. Now I have it in my household. I get to use it. So when I'm using it, that's not buying it. So I say, if you write this C does not represent the use of a product, it represents the purchasing of that product. Then same applies to G. If you write government, you are wrong. G, that's government spending, not government. X, that's your exports. M, imports. I, investment, or you can say investment spending, or you can say investment spending by businesses. T, that's your tax. This little triangle stands for change in. This, not really important, profit, subsidy. I should replace this for S. We are savings. Then we have I, small letter I, that's interest. L, that's leakages. K, that's the multiplier. Okay. Then number 14, the flow. So now it takes us back to the flows. So the answer is one of these two. Are we clear? But let's listen. The flow of what? Now, if you look here, we have the household supply factors of production, solid line. Right. Let's see. So the flow of goods, services, and the 4 factors of production, that'll be real flow. Number 15, the flow of money, e.g. consumer spending, income, tax, etc. This word gives it away as money flow. Then the model equation for GDP, that's C plus G plus I plus X minus M. Then number 17, when we have investment, government spending, and exports, that'll be injections, or J. When we have M, S, and T, that's leakages. Number 19, when leakages are equal to injections, the economy will be in equilibrium. Then number 20, when leakages are greater than injections, the economy will decline, because look, what's going out, which is leakages, is more than what's coming in, which is injection. So the economy will drop. Number 21, when leakages, what goes out, is less than what's coming in, definitely our economy is going to grow. Then number 22, goods and services are traded. We talked about this one. We said goods and services. Look here. Whenever we see goods and services, it's happening on the product market. Okay, so goods and services are traded on the product market. Then the 4 factors of production are traded on, you see, household supply factors of production on the factor market. Then the next one, used as means of borrowing and lending in the short term, this one will be the money market. Then consists of banks, pension funds, insurance companies, and the JSE. This one will be consists of banks, insurance companies. This one will be the financial market. Then where individuals and institutions trade financial securities in the long term, this one will be the capital market. Where one currency can be exchanged for another, this is the foreign exchange market. If you say foreign exchange, your answer is wrong, because foreign exchange is the act of exchanging one currency for another. That one is like an act. It's a verb. It's a doing word. Foreign exchange, the act of exchanging one currency for another, you can actually do it. But this one is asking about a place. Where are you going? I'm going to. You see? So a place where one currency can be traded for another, that would be a foreign exchange market. If you say foreign exchange, you are wrong. We also have another term that can also, sound the same as this, which is exchange rate, which is the rate at which one currency can be exchanged for another. Now, 28, the total market, maybe I must add the word market there. The total market value of all final goods and services produced within the borders of a country over a period of time, usually over a year, that will be gross domestic product, GDP. We have three methods: income, production, and expenditure method. And what we know is that these three are equal. Like income is equal to production and equal to expenditure. So it wouldn't matter which method we use, we get the same answer. Now let's look at the production method. How would we calculate GDP using the production method? Well, we say primary sector plus secondary sector plus tertiary sector equal to GDP at basic prices plus taxes on products minus subsidies on products. It will give us GDP at market prices. I'll show you the whole thing just now. Then we have the income method, which will be compensation of employees plus net operating surplus plus consumption of fixed capital equal to GDP at factor cost plus other taxes on production minus other subsidies on production equal to GDP at market prices plus taxes on products minus subsidies on products equal to GDP at market prices. Last but not least is the expenditure method. Now this method is more like C plus G plus I plus X minus M, but you must remember residual item here. So that would be C, that's your final consumption spending by households. Number 2, final consumption spending by government. Then gross capital formation, that's your I, investment. Then plus or minus residual item, it gives you expenditure on GDP, or gross domestic expenditure, I can say that. Then we add exports, we subtract imports, we get gross domestic expenditure at market prices. Now, this one, let me just put it out there, okay, just for you to see it again. Okay, there we have it. So we have these three methods. If you want to quickly just write them down, if I was saying it fast, then 31, that's your compensation, net operating. I might need to explain something. So compensation of employees, that's net salaries and wages. Net operating surplus, that's profit. Then consumption of fixed capital, that's depreciation. You'll see a question that kind of says more or less the same thing. I'll show you that question just now. Basically, that's where we're going. Okay, it's here. So when we're calculating GDP using the income method, what means gross salaries and wages? So that would be compensation of employees. Then when calculating GDP using the income method, what means profit? That would be net operating surplus. Then number 35, when calculating GDP using the income method, what means depreciation? That would be consumption of fixed capital. Then what is used to deal with omissions or error? That's a residual item. Then an example of tax on production, that would be pay as you earn, personal income tax, things like that. An example of other subsidies on production, that would be an employment subsidy. An example of taxes on products, that's VAT. An example of subsidies on products, that would be bread subsidy. Now I have learners writing bread. It's wrong. Bread is not a subsidy, but bread subsidy is a subsidy. So if you write bread, I'll mark you wrong. Number 41. A measure of income earned by South Africans regardless of where they are in the world. This will be gross national income. Take note. Some learners will write GNP. I don't know where they're getting it from. It says income. Now here, 42, a measure of the value of goods and services produced. This is gross national product. Now, each time we hear this part that says citizens, this one says South Africans. It's talking also the same. It's saying citizens. So when we say citizens, we call it gross national. When it's within the borders, it's now gross domestic. Now, what is the internationally agreed standard set of recommendations on how to compile measures of economic activity? That's systems of national accounts. Then if you were given, actually, how would you convert something to real GDP? Well, it's kind of vague here, but we want you to tell us, how would we get real GDP? Well, if we are given nominal GDP, which you write here, we multiply that by 100, you divide by the deflator. If you do that, we are calculating real GDP. So now we're on conversions. Right, how would you convert factor cost to basic prices? Now, this we have done already. It's the same thing. Look, if you have factor cost, this is factor cost. And you want basic prices, this is basic prices. What do? You add taxes on production. Take note, production. Then what do? You subtract subsidies on production. Then what do you get? You get GDP at basic prices. So basically we are just reversing what we did. Now, how would you go back? Look here, it says factor to basic. Now basic back to factor. Now what you would do in that scenario is you would have to flip the signs. So if what took you from factor to basic was adding taxes and subtracting subsidies, if you want to go back, now you have to flip the sign. So this now you add. So you have to add subsidies and now you have to subtract taxes. Okay, it's as simple as that. So if you check here, I've already given you the sign. So I started with addition. So what do we add? We add what we subtracted before. So we subtracted subsidies, so now we add subsidies. Then here we subtract tax, because here we had added the tax for us to go from factor to basic. So now we're going back. Common sense. Then how do we convert from factor all the way to market? Well, we have to arrive to basic first. So basically what we're saying is, how do we go from here all the way to here? So we go through all these processes. What you see here, we go through everything that's highlighted there, except for my name. Right, so this is what we do. Simple as that. So let's do it. What we would do in that scenario is we'll have to add, subtract, get, add, subtract, get. Right, moving on. How do we go back? Same scenario, flip the signs. Then basic to market, it's simple. We have basic somewhere. Where is it? Here is basic. Basic. How do we go to market? We add taxes, we subtract subsidies. But now products. Take note, here is production. Here is products. Don't mix them up. Don't mix them up. All right, then the next one, I'm showing you answers which I shouldn't. Let me go back. So then now we're done here. Then we go to 51. How do we convert gross domestic product to gross national product? Well, we basically, I told you domestic means within the borders, national means citizens. So citizens of a country are in the country and some are outside the country. So for us to convert this GDP to this GNP, we simply add primary income from the rest of the world. We subtract primary income to the rest of the world. We get gross national product. Then how do we go back? You see here, now we're going back. Now we flip the signs. So basically what I said here is what you write here, because I have already flipped the sign. If you want to say it, if I didn't change, then what you had written here, you put it here. No. Yeah. So basically the issue is about flipping the sign. So I flipped it. So basically what's here goes there. Exactly, word for word. Now, the last portion of our preparation is based on the principle that spending by one becomes income of another person, which then becomes that person's spending, and so on. That's the multiplier. Then 54, described as a situation when a change in spending causes a disproportionate change in aggregate demand and hence aggregate income. That will be multiplier effect. The next one, consumption, which is affected by the level of income, we call it induced consumption. Then the opposite is autonomous. So consumption which is not, I left out affected here. So consumption which is not affected by the level of income, it's autonomous consumption. Then our formula, change in income, so Y divided by change in injection, J, or K is equal to 1 divided by 1 minus MPC, like that. Right, then moving on, we have a scenario here. Royal School spent 3 billion to build a new school in Alberton. If the MPC is 0.7, calculate number 1, the multiplier. So to calculate the multiplier, we are given the MPC. So we take this 0.7, we put it here. Then we put 1 here. So K is equal to 1 over 1 minus MPC first. Then K is equal to 1 divided by 1 minus 0.7. Then K is equal to 1 divided by 0.3. Then 0.3 goes into 1 3.3 times. So the answer is 3.3. Then number 58.2 says, what's the effect? So we take the answer we got here, we multiply by the injection of 3 billion. So we get 9.9 billion here. You will see it just now, I'll show it. Then lastly, what is the relationship between the multiplier and the MPC? The relationship is that the higher the multiplier, the higher the MPC, and vice versa. Okay, so let me show it here now. It's difficult to, just talk about numbers and ignore. All right, so there we have it. All right, there we have it. So first, here's the formula we were talking about. Here it is. You get your 4 marks. You mess it up, you don't. Now, many learners will do only this portion. No. Many will do either this and this. I give them 2 marks out of 4. You get your marks. Whoever is marking must be strict. 1, 1, 1, 1. Give us the formula first. Replace your MPC with the MPC you were given. Then do the rest and then you are done. Okay. So then, like the other question I said, we take the injection of 3 billion, we multiply by the answer, the 3.3 that we have here, we get 9.9 billion. Now, some learners will round this off. They write 10 billion. I think, let's mark them. Then here's the relationship and so on. So this got us to the end, and thank you so much. God bless.